Thank you for joining us for today's webinar. So today we're joined by our friends at Pepper Money, and we're going to be talking through complex buy-to-let and adverse residential. So very quickly then, who are Crystal Specialist Finance? For those of you that are new to our webinar series, we are an award-winning specialist distributor. So what that means is we've got over 80 lenders on panel across our 6 main business sectors, which we'll come on to shortly. And they include both exclusive and semi-exclusive products and lenders. But where we're slightly different is that we are dedicated to the intermediary. We don't work directly with consumers. And for us, it's all about ensuring that you have the tools that you need in order to place business for your clients. We've been in business now for a number of years. We're still family owned. And as a team here, we've got over 200 years collective specialist finance experience. So this is all we do. We don't do vanilla. We don't do the standard residential or anything like that. For us, specialist is our normal. And we are passionate about specialist finance. So you've placed your trust and your customers' trust in us, so it's up to us to deliver. So we need to talk to you to provide updates on cases and not just hide behind portals and technology. So for us, you'll have the phone number of any dedicated case managers that you're working with, and they'll always be available to explain to you what's going on with your deal at any time. We know we're only as good as the last case that you've done, and we want your next one. So we will assist and support you throughout the life cycle of that case and beyond. And for us, our key driver is service. Flexibility means that we can find unique solutions for your customers, and the relationships that we've built up over the time the business has been in existence means that we can do things that a lot of other people can't. We aim to do things quickly. We know time is money. We don't make any money here. We don't have any acceptance fees or anything like that charged until completion of the loan. So for us, it's all about actually delivering on that and making sure your client gets funds in their bank account as quickly as possible. We're really big on education. So events like today, we keep you up to date on market trends. We provide webinars, promotional material, educational documents, just to ensure that you're one step ahead. Again, I touched on at the start there that we don't deal direct with the consumer. So for us, it's all about ensuring that you've got the tools that you need and the knowledge you need in order to be able to spot these opportunities when you're sitting in front of your clients. We all know how much the market has changed over the last few years. That shows no signs of abating. So it's all about staying on top of trends, staying on top of what's available, and making sure you can really maximize all of the relationships. And again, specialist finance can appear daunting. It is a little bit different. It's very similar in many ways to what you do normally. There are some slight nuances. There are things that lenders do that are a little bit different. So it's our job to ensure that we can get these across, that we can communicate with you, you understand where we are, what we're doing, and that we can really make the most of everything that's happening. Transparency is key for us, that we make sure nothing's hidden, everything's agreed up front, so your client knows exactly what they're going into. And again, we're all human, so we know cases will hit problems. It could be a valuation issue, it could be difficulty proving some income, it could be a variety of different things. So for us, it's all about solving that problem. How can we find a solution? So we'll either resolve it, we'll work with the lender to find an amicable solution for all parties. Alternatively, we will find another lender. And if we can't, if the problem is insurmountable, then we will tell you that as soon as possible. It's pointless dragging a case on for weeks and weeks and weeks when there's no outcome for it. It's all about looking after that customer, ensuring that customer journey and that customer experience is the very best it can be. And for us, that covers you and it covers your client as well. Technology, we need to make sure that we're working with the right things at the right times to make your life easier. And again, use our expertise, use the people power that we have here in order to help you complete your cases. We have over 50 staff here dedicated to working with intermediaries and working on specialist cases. Use that resource in order to complete deals. So that's a little bit about us. Specialist finance, there's the 6 main sectors that we work in. So residential, again, it's the quirky. So for us, new build, first time buyers. Ex-local authority, limited income proof. As Phil will come on to shortly, adverse credit is a really strong area at the moment in specialist finance. So it's certainly an area that you shouldn't be overlooking. So with buy-to-let, HMOs, limited companies, portfolios, student lets, again, we're looking at unusual properties, unusual circumstances, unusual structures, or even professional landlords, people that have grown out of the typical vanilla buy-to-let lender who want kind of up to 4 or 5 properties. Commercial, something that we're probably best known for. We still love commercial transactions. And this could be anything from a shop on a high street through to an office unit and everything in between. So mixed use, residential above, semi-commercial and expats. One area that we've seen a real growth in over the last 12 months or so is that semi-commercial investment. So where your buy-to-let landlords, for example, are getting lower yields on their residential buy-to-lets, they can quite easily look into that semi-commercial space. So shop with flat above. The flat is run-of-the-mill for them. It's what they're used to doing day in, day out. Add the commercial to it, it just increases that rental yield. Normally the tenants in commercial stay in for a lot longer, so it's quite a nice bet rather than changing every 6 months. So it's quite a nice angle for some of the investors to go into to maximise their returns. Second charge, something that we all should be considering. We can do these on residential buy-to-let or commercial properties. They can be used for a variety of purposes: home improvement, capital raise, debt con, holiday fees, school fees, etc. Or even raising money to put into a business. Bridging finance, we love bridging. Something that we do really well, something that we really enjoy doing, and something we've got some really strong relationships in. So this is any kind of short-term lending. So any loan for typically up to 12 months. Some lenders will stretch that to 18, and in certain circumstances even up to 36 months as well. And then you've got your traditional uses there. So auction funding, below market value transactions do still exist. And particularly at the moment, we're seeing a lot of light and slightly medium to heavy refurb in that as well. So if you're buying a property, doing some work to it to either sell or to add to your portfolio, you should definitely be considering bridge. And then development could be anything from a conversion of something through to spade in the ground up building. And again, particularly strong areas there where it's low value, where it's overseas borrowers, where it's something complicated, so a trust getting involved, something like that. And again, our strengths, we understand the market, we know what specialist is, we know how it works, we know how to get it done, and we explain that to you and get that done quickly. So with that, we're looking things like adverse credit, low credit scores, tight deadlines. We've completed cases in under a week where we need to. Overseas borrowers, where we have to be a bit flexible on sources of income and consider various different income streams, especially when we're looking at multiple sources of employment, maybe self-employed, maybe a bit of employed but with 0 hours contract, so they're doing a bit of other work. And even older clients lending into retirement is obviously a growing area that we're all looking into. The specialist residential, first and second charge, later life, and again it's the complicated there, so right to buy, shared ownership, help to buy. Terms can go up to 40 years. Lenders have got flexible income assessments, so some are talking 4s, 5s and 6s on income multiples, but more so at the moment it's on an actual income expenditure assessment to make sure the client can afford that loan. And again, their new build, non-standard construction have always been good areas for us. We could do first-time buyers, self-employed contractors, and there are lenders offering free valuations. So the specialist buy-to-let, again, very low rates on some of those. So here, limited companies, portfolios, we can lend to trading companies as well as SPVs. Adverse credit is fine for a number of lenders. Consumer buy-to-let is still fine, and we can lend all across England, Scotland and Wales. There's been a lot of talk over the last few years about transferring properties into a limited company. So is that the right thing to do? That's a difficult one to answer. We are not tax advisors, and I'm sure most brokers listening to this are not tax advisors either. So by all means, we can discuss the options with the client, we can tell them the implications, but please refer them for independent tax advice. It's essential because, as we'll see in these scenarios, what's right for one applicant might not be right for another. And it's really important that we don't start treading on the toes of tax advisors. We don't start leading the client down a road that we don't fully understand. So for us, it's all about making the opportunities available, showing you what to do, and then getting the advice of a tax advisor from there. So in this scenario here, purchase price 250,000, the value now is 1.1 million. Because it's been transferred from an individual to a limited company, it's a purchase. So the stamp duty payable, which in that scenario there is 85,500, and the seller is also liable for capital gains tax. So Kris Corns selling it to Kris Corns Limited. Kris Corns Limited pays for the stamp duty, Kris Corns Personal pays for capital gains tax. So the total cost of that transaction there, even though I'm the same individual behind it all, total cost there £320,470 just to move that into a limited company. What we see with limited companies is the rates tend to be a little bit higher. The accounting implications are obviously a little bit greater than they would be normally. So it's a toss-up between, is that the right thing to do? Have I got other plans? Are there inheritance tax planning? Are there things that I'm trying to look at there that would make this worthwhile for me? Am I looking to grow my portfolio? Am I looking to purchase more properties and add that to it? So is this stage one of a process? That's why that tax advice is really essential. So having looked at the costs, and it's relatively expensive in that scenario to do that, the limits on mortgage interest relief only apply to individuals, so they don't apply to limited companies. So a limited company can continue to offset 100% of the mortgage interest costs. The profit can be retained within the limited company and tax not paid on it at that point. The profit can be retained within the limited company and used for reinvestment purposes. The rate for corporation tax is lower for individuals, so it's dropping to 17% by 2020. And the new dividend tax provisions mean that the first £2,000 is tax-free. The dividends above that taxed at 7.5%, 32.5% or 38.1%, dependent on individual tax circumstances. So you can see there's a few things that you need to consider beyond just the initial stamp duty, beyond just the capital gains tax. Does that make for a better position for the client and leaving it in the individual name and then being subject to mortgage interest relief over the next few years? So buy-to-lets have undergone a number of changes, as we've touched on. So a lot of lenders now are looking at a full review of the customer's portfolio. Do they have any risks? Do they have any geographic or concentration issues? What kind of spread of products do they have? How highly geared is their portfolio? What's their personal income position? And can the model cope with rising tax costs? The lender may want to sense check the customer's tax code. Have they got a plan? You've seen a number of lenders now ask for business plans to ensure that the client has got a full handle on what they're looking to do. Full asset liability assessment, cash flow assessment are all looked at now by a number of the more vanilla lenders that previously would fast track a lot of these buy-to-lets. They have new processes, procedures. So what it does mean is that for a portfolio landlord, there are less lenders available in the standard market, which means more specialist products need to be made available. And again, I don't need to tell you then that the profile of the borrower has changed over the last decade. We've now got grandlords coming to market, people wanting to own properties a lot longer. More and more landlords are now being classed as portfolio landlords, owning over 4 or 5 properties. Limited companies are now coming to the fore. Overseas borrowers, expats, and overseas companies are still investing in the UK. Again, all the issues we have over Brexit, regardless of what happens there. The UK has always been seen as a safe haven for property, and with the fluctuating performance of the pound, that changes the investment appetite from overseas investors. But more and more self-employed people wanting to get involved within buy-to-let. So jumping across to residential, quick case study. 67-year-old dentist in London coming to the end of his term on his residential. Original plan, retire, sell, downsize, move away. However, he saw the opportunity still within his business, wasn't quite ready to retire as he initially planned, so he decided to give it 5 more years. So the problems the broker was coming up against there was age, actually the term, taking the client well into retirement, and he'd been running the business down due to the fact that he was looking to exit. So we discussed the case with one of our panel lenders. We managed to identify a bespoke 5-year interest-only option available for the client, which wasn't on plan for the lender, but the scenario made sense. Ticked all the client's boxes. Nice, straightforward completion to get the client what he's looking for. Second one, a broker approached us struggling to place a property set in 5 acres of land. Really good client, clean, good income, no issues. The only problem was the unusual property type, so the large plot on which it sat. The land, it wasn't used for anything, it was just the grounds of the property, so a big garden basically. Specialist lender did this for us at 3.59. Lender was happy with both the client profiles, the specialist nature of the security, did it with free valuation and completed in just 4 weeks. Another one for you, client owning 2 small buy-to-let properties in the southeast, wanted to purchase more. He'd seen the news story, saw that yields were better for him outside of the southeast, so identified 4 properties up in the north that he wanted to purchase. HMO, buy-to-let, new build flat, a flat above a shop. So the issues the broker was facing there, lenders were querying how could he manage those properties in the north while he had his main business in the south. He got no experience at running a HMO or a flat above a shop. How does that differ to what he does normally with his standard buy-to-lets? And all 4 properties were worth under $75,000 each. So approached a commercial lender who viewed that, did the whole portfolio, 1 transaction at 3.89 on a 10-year interest only. Due to the manual underwriting involved, commercial lenders are much better placed a lot of the time in order to take a view on situations. We can also probably expand that now into the specialist buy-to-let market where the lenders don't rely on online calculators. They don't just rely on a decision system to say yes or no. They actually get the paperwork out in front of them, review the case and decide whether this makes sense from a lending point of view. Large portfolio with a complicated overseas structure. So BVI, registered limited company, 3 directors in Singapore, looking to remortgage a large portfolio to redeem various lenders and also release capital to purchase additional properties. But added to that, the income didn't quite meet standard requirements, so we needed to look at top slicing. So we managed to get this done at the full loan amount using a lender that took a view on all of the issues that we got there. Managed to source off offshore opinion letters in order to confirm the structure. Got that done in 3 weeks from application, meaning the client could move on and purchase the property very quickly. So moving on to Pepper specifically, we have a packager exclusive with Pepper that we'd like to make available to you. This is available on residential and buy-to-lets. So residential, there's up to a 0.25 discount on the standard rates. Buy-to-let is up to a 0.9% discount on their standard rates. Pepper will look at loans up to 85% LTV, loans up to 750k up to 85%, and $1 million up to 75. But I won't steal too much of Phil's thunder on that. I'll let him talk you through the products there. So from us, basically get a deal into us however is easier for you, be that email, through our portal, give us a call, come and visit us, or see us at the number of events that we do over the country. As soon as we've got the information, one of our new business team will discuss that with you and find the most competitive terms we can do, get those out to you, get you the most relevant product for you to discuss with your client. If they're happy to proceed, fill in the forms, and that's where the real action starts. So once we get the forms back in, we've then got consent to do things like the credit search, land reg search, and actually start then handling the client's data and moving that case forward. We then handle that right the way through to offer and then beyond. So we work with the solicitors on the transaction as well in order to try and get that case completed for you. Because again, as I touched on at the start, for us it's about getting the money in the client's bank account quickly, easily and smoothly. As the market changes, there's never been a better time to start diversifying and looking at different products. The market's changing, the clients are changing, the products are different, property types are changing. And again, lenders keep changing their processes, which sometimes seems to make it harder and harder for us to get cases through. So that's why using a specialist distributor and using Crystal is important in order to maximise every opportunity that you get. So pick up the phone, speak to us, and let us help you out with all of your complex requirements. So thank you for listening. Gives me great pleasure now to hand you over to Phil from Pepper to talk you through their presentation. Thanks, Phil.
Hello, my name is Phil Quinn, National Account Manager at Pepper Money. Thank you for joining the joint Crystal and Pepper Money webinar. Today I'd really like to talk to you about two things. One being the specialist market in general, give you an idea what's happening there, where we think it may go. And then I'll come on to talking you through Pepper's proposition and how you can work in conjunction with Crystal to find a solution for your clients. The big one for me this year is that it's expected 1 in 5 cases that are broker keys will be going away from the high street. Now that's not necessarily a specialist lender, it may be a small building society. The debt in the UK is rising. We're now at £1.6 trillion, and over the next 5 years it's expected to rise to 2.4 trillion. One of the key reasons why specialist lending is so important at the moment, because complexities of income, of adverse, non-conforming type of applicants have to have a different alternative, and a lender like Pepper is where we can support. Let's have a look at CCJs. Now, since 2012, the volume of CCJs has increased year on year up until 2018, where we have 1.1 million registered CCJs in England and Wales. Now, for the first quarter in 2019, it's actually the first time we've seen a decrease year on year for the volume being registered. Will that set the new trend? Only time will tell. But it's really quite astonishing how many have been registered over the last 7 years. Now, bearing in mind it stays on the credit file for 6 years, there are in excess of 5 million CCJs. All of these applicants will potentially struggle to fit with High Street. And this is where it's crucial to understand how a specialist lender can help, so that in turn we can help the customer. Now, the average value of those CCJs is £1,400. Back in 2008, when the credit crunch hit, the average value was £3,500. So the trend is quite clear to us. The volume of CCJs is increasing, the value decreasing. And I see that there are two key reasons for this. Firstly, it's a lot easier than ever before for a company to apply for a CCJ. Secondly, companies are registering CCJs for less significant events. And that will be things like parking fines, council tax, TV licence, utilities, mobile phone bills. If you've got a £60 parking fine and you've not paid it in 60 days, that could turn into a CCJ. All of these applicants, remember, will potentially struggle to get a high street mortgage. Let's have a look at Pepper products and how we can help. So, what can Pepper do for you? Well, firstly, we're only intermediaries. There's no direct access to us. We've got an excellent relationship with Crystal. They know how we operate and they can help you place the business. We don't credit score and we manually underwrite. The advantage of not credit scoring is that we're able to rely on a search, not judging someone based on the number of points they've accumulated. Now, we only use Equifax. It's also a soft footprint at the dip stage. Should you see an applicant who has a CCJ or a default, we don't have a limit on the value. They can also be registered as recent as 6 months ago, and they don't need to be satisfied. We've introduced new products with a £0 completion fee, and we will also accept an applicant if they are on a debt management plan, or DMP for short. Now, the criteria surrounding debt management plans is that we will accept one per application. On residential only, they have to have had the plan running for 12 months and can't have missed a payment on it in the last 12 months. The applicant can either continue the DMP or can consolidate it as part of a remortgage. We also have an exclusive product with Crystal where we offer higher loan to values for heavier adverse. Hot criteria. A lot of people will use Pepper for self-employed income. We accept 1 year's trading. We don't look at the track record, we don't need a projection. Plain and simply 1 year. Net profit for sole traders and partnerships, salary and dividends for limited companies. We also accept the latest year's self-employed in isolation. So if you've got a business that has 30, 40 and 60, we will take the 60,000 being the latest year without averaging. We use multiple sources of income at 100% if they're paid regularly. So this would include things like overtime, shift allowance, commission, bonus. If it's paid weekly or monthly, we take a 3-month average and use it all in affordability. Bonuses that are quarterly or annually, we require a 2-year track record and we'll take an average. We'll also lend up to age 75 based on plausibility of the occupation, and that's using current income without the need to produce any pension evidence. If you've got an applicant who is in a manual job, such as a scaffolder, roofer, builder, that will be capped at age 70. Interest only. Now, we've seen a spike in interest only lending, and I remember reading a UK finance report last year to suggest that 2019 and 2020 are the years where we'll see the most cessations in the market from interest only mortgages back in the 90s, where endowments haven't met their purposes. And we start to see this quite often where a high street lender will be writing to their customer every year. The letter will be redder and redder, bolder and bolder. Your mortgage is coming to an end. What are you going to do about it? Now, a lot of brokers will think we have to start going down the equity release route, or we may have to advise the client to sell or to move on. But there are lenders out there, such as Pepper, where we may be able to offer, albeit a temporary solution. So here's how our interest-only policy works. We accept up to the age 75, 60% loan to value, sale of the main residence. We also look at underwriting the cases on interest only. Therefore, affordability-wise, we should be able to lend if it fits affordability, because we're not looking at the case on a repayment basis. It works very well for applicants in their late 60s who are suffering from the endowment declines. Debt consolidation, we do up to 85%, and we don't apply any debt to income ratios. So if you have an applicant who is earning £40,000 and they have £50,000 worth of debt, we can proceed subject to affordability without worrying about debt to income. Contractors. We've been operating in the contractor market for 12 months now, and this is your traditional type of contractor where we use the day rate rather than treating as self-employed. So our criteria is minimum £200 a day, times 5 times 46 weeks. It doesn't just have to be IT, we can accept any industry. The applicant must have been contracting for 12 months and they need to have 3 months remaining on their current contract. How do we service? So we have an excellent application system which Crystal are very familiar with. It's a soft footprint at dip stage as previously mentioned, and we will also underwrite dips on day one, and we are currently underwriting full applications within 48 hours. So we believe we provide excellent service. Manual income stretches are available. Like many lenders, we do base our lending on affordability, but if you do have a case where you believe there is a good amount of disposable income, we can look to stretch the income subject to underwriter review. Overall, we do have a superb relationship with Crystal. Conversion rates are what indicate that. Because they know how we operate and have experience using our systems and understanding our policies, great reason to be using Crystal. So let's have a look at our packaging and what documentation we request. Well, as you can see, everything we request you should have for your own compliance, and there is nothing jumping out here that is out the ordinary. Payslips, bank statements, or accounts for self-employed, your normal documentation, declarations and direct debit mandates. We turn the cases around quicker if the documentation is uploaded to the system. And how we operate is that when the case is reviewed by an underwriter within 48 hours, if we are satisfied, we will instruct valuation immediately. Should we require anything else, we will go back to Crystal, who in turn will go back to you, and will ask for any remaining documentation. There are a few things to look out for. So firstly, payday loans on bank statements. Our policy in Pepper is that we won't allow anyone to have a payday loan in the last 12 months. And this really is for your information, that if you're reviewing a bank statement, it's worthwhile checking certain types of credits, especially those where you believe it could be a loan. Jump on Google, have a look at what the trading name is of the company, because it's not always so obvious, but it is something we'll look for. Gambling on bank statements. Our take on this is that we will take a logical view. If someone is clearly a serial gambler, every transaction is to a betting shop or a betting company, it's hard for us to be able to consider lending to that applicant. If you've got the odd little gamble on there, it may be okay. Best thing to do is to run it by Crystal. We do require applicants to be employed for 6 months with their current employer, and they do need to have a 12-month employment track record. And we will also be looking at the general conduct on bank statements. And what we're looking at here is, do they rely on their overdraft? Do they have lots of cash coming in, which they may be wanting to use to support the mortgage? So just general conduct. My advice is, if it was your money that you were lending and you were assessing the bank statements, what decision would you give? And based on that should in turn help us as a lender determine what we can do. Let's have a look at Pepper rates and our tiering system to see how we can help an applicant. So our rates here are as of June 2019. If you take a look to the left hand side, you'll see the words Pepper and then a number. So we have Pepper 48 all the way down to Pepper 6. And this refers to the number of months since an applicant has had a CCJ, default or mortgage arrears. So it's a simple way to understand what tier the applicant will sit on. Example, if an applicant had a £3,000 default 6 months ago, they will sit on Pepper 6. If they had mortgage arrears 2.5 years ago, they'll fit on Pepper 24. What you can also see is that we have a separate DMP product, criteria I talked about earlier, and we offer 2 and 5 year fixed rates, both with and without completion fees. There is also a small application fee of £135, which is non-refundable, and we will then take a valuation fee, but only instructed after underwriting. On a remortgage, we offer free legals, and that's provided by a company called Russell & Russell. So although we are a specialist lender, you can clearly see specialist lending doesn't mean specialist rates. We start at 2.9% on the Pepper 48, and on a Pepper 6 on a 2-year product, 4.23. I'd now like to have a look at some case studies to put it into practice. So let's have a look at the first case study. This is an application to raise capital for debt consolidation by 2 applicants. Nikki and Jacob had a life event within the last 2 years. It resulted in 2 CCJs totaling £25,000. The 2 CCJs were registered against them 13 months ago, and they require 80% loan to value. Well, that's fine for Pepper because it was 13 months ago. We don't have a limit on the CCJs. 80% is okay. It will be a Pepper 12 product. Case study 2. This time we have an application to remortgage an existing main residence by 2 applicants. Robin is a day rate contractor. Christine is aged 59 and unemployed. They require 60% loan to value over 15 years, and they're looking for interest only by way of sale of mortgage property. So we can see here there is no adverse credit, but a combination of our day rate contractor policy and 60% interest only sale of main property is the reason why this case has come to Pepper, and we can do this on a 2-year fixed rate at 2.9%. Our third case study is an application to purchase by 2 applicants. Isaac is self-employed, trading for 1 year. Oliver is employed on a basic salary with high monthly commission, and he had a payday loan paid off over 1 year ago. Now, both are first-time buyers, no current active credit, and they're failing high street credit score. Likelihood is because of the payday loan just over a year ago, and they're looking for 85% loan to value. Well, again, there's no current adverse credit. Pepper, we don't credit score, so that's a tick, and we can look at applicants who are trading for 1 year. We use 100% of monthly commission, and this is why the case has come to Pepper. Our mission for 2019. For the remainder of 2019, our campaign is Mission Possible. We want to be able to help applicants who are undeserved by the high street. Defaults and CCJs shouldn't get between your client and their mortgage. We want to be able to help applicants get on the property ladder. We've recently reduced our rates on some of our 5-year products. We've introduced 0 completion fees. We have flexible criteria for multiple CCJs. There isn't a pound value limit for CCJs, and they don't need to be satisfied. And we will consider as recent as 6 months ago. Thank you for listening to today's webinar, and thank you for Crystal who have organised the session. I'd now like to hand you back over to Kris.
That concludes today's webinar. Thank you all for tuning in and listening. And remember, if you do have any cases you'd like to discuss, please give the guys a call, 01827 301070, and we'll be more than happy to discuss your needs with you. Thank you.